Hi, I'm CG Philip, tracking the banking and financial services sector at Mirae Asset Capital Markets. I have been looking at BFSI sector for more than 15 years. Prior to joining Mirae, I have worked in HDFC Securities and Axis Securities. FY23 was one of the best years for the banking industry. This was highlighted by healthy loan growth of more than 15% year-on-year, peak NIMs for most banks on high yields on loans and low credit cost. In first half of FY24, several factors supported credit expansion, with the retail and MSME sectors exhibiting robust growth along with gradual uptick in the corporate book. Earnings was driven by healthy business growth and sustained improvement in asset quality. However, the margin trajectory continues to compress, led by a rise in the funding cost. Over the past 6 months, RBI has been citing concerns over the rapid growth in the unsecured loans. Basically, these are the personal loans and the credit cards over the past 4 to 5 years. Recently, on expected lines, RBI increased the risk weight in these categories of loans. We estimate the direct impact on the Tier 1 capital, but banks are likely well capitalized and should not need to raise additional capital. We expect the indirect impact to be a moderation in the unsecured loan growth for banks over the quarters to come. We estimate FY24 earnings growth to be remaining resilient, guided by the robust traction in loan growth and a benign credit cost. As the CD ratio remains elevated, healthy growth in liabilities will be critical in sustaining loan growth. We expect competition for deposits to intensify further, resulting in a rise in the funding cost in the coming quarters. We expect NIM moderation to continue over the coming quarters due to the ongoing repricing of liabilities, but the pace will slow down. Banks with a higher CASA mix are well positioned to navigate the rising rate environment, even as the funding cost is likely to increase. The asset quality outlook remains encouraging, with a moderation in slippages, healthy PCR, and contingent buffers driving benign trends in the core credit cost. Provisioning expenses continue to remain benign for most banks, and while the turn in the delinquency cycle in respect to unsecured loans keeps us watchful, we expect credit costs to remain under control over the coming quarters. We prefer stocks that can deliver some strong growth both on the deposits and the advances, have a positive ROA bias, visibility on MD and CEO continuity, and reasonable valuations. On the broader outlook, despite the run-up which Bank Nifty has seen over the past couple of years, valuations for most stocks are reasonable at below or closer to long-term average. Another trigger for the banking industry is the revival in the corporate capex. Corporate balances are currently at low leverage. The balance sheets are having a very low debt to equity ratio. If capex cycle recovers at a faster pace, we believe BFSI will be the key beneficiary as a domestic play among sectors. Balance sheet strength of Indian banks has been strong and is likely to remain so as delinquencies have been low. As banks continue to digitize more of their processes, products, and services and invest in technology, we can expect operating costs to come down further and further improvement in the last mile connectivity. We have seen over the past 1 decade major changes happening in the BFSI space, with the growth of NBFCs, entry of small finance banks, and listing of allied services such as insurance. Another key factor in favor of banking system have been the rise in digital payments with the onset of UPI. India's digital payment industry is expected to more than triple to $10 trillion by 2026, We believe these factors are conducive for a long runway of growth in the overall banking space. Thank you.